All right, let's break down the events of February 3rd, 2026. What we saw today wasn't just another down day for tech. This was a critical inflection point, a brutal divergence in the market. It was a day defined by a violent sorting mechanism, driven by a fundamental and, frankly, terrifying shift in the AI narrative.
And look, this chart really tells the whole story in just 2 bars. You have the NASDAQ, the proxy for big tech and high growth, down almost 1.5%. And right next to it, you have the Russell 2000, the index of small-cap, domestically focused companies actually finishing in the green. Now, this isn't just a mixed market. This is a schism. It's a fundamental disagreement about where future value lies. So the question we have to answer is, what single force was powerful enough to tear the market apart like this?
So to really understand the scale of what happened, we need to look under the hood at the major indices. The numbers paint a very clear picture of where capital was fleeing from and where it was desperately seeking refuge.
Okay, so here's the scorecard. The NASDAQ 100 was clearly the epicenter of the damage, down 1.43%. No surprise there, given its heavy concentration in high-beta software names. The S&P 500 was dragged down with it, but the damage was mitigated. Then you have the Dow Jones, down only 1/3%, really sheltered by its weighting towards industrials and consumer giants. And then the outlier, the Russell 2000, up 0.30. This isn't random noise. This is the clear, unmistakable footprint of a major capital rotation out of long-duration tech assets and into value and real economy cyclicals.
So what was the catalyst? What single event could possibly trigger such a specific and brutal repricing in one of the market's most crowded trades? Well, it all came down to a single product announcement that sent a shockwave of, and I'm not exaggerating here, existential fear through the entire software industry.
The trigger was the launch of something called Claude Cowork by the AI startup Anthropic. Now, this wasn't just another AI feature or a slightly better chatbot. The market immediately interpreted this as a direct existential threat, an AI agent designed to automate the very corporate, legal, and administrative tasks that form the bedrock of the entire software as a service, or SaaS, business model. It posed a devastatingly simple question. Why would a company pay for dozens of separate software licenses if one single AI agent could do most of the job for a fraction of the cost?
And that fear immediately got a name on trading desks, the SaaS apocalypse. Now, this isn't just about new competition. This is about total commoditization. The market began to aggressively price in a future where the high-margin, recurring revenue streams that made SaaS companies so attractive could just evaporate. All of a sudden, the terminal growth assumptions for the entire sector were thrown into question. And this wasn't just a theoretical fear. The impact was immediate and it was brutal. We saw established blue-chip software giants, we're talking Salesforce, Adobe, get crushed, plunging between 7 and 10% in a single day. The IGV, that's the iShares Expanded Tech Software Sector ETF, absolutely plummeted. This was a panicked exodus, driven by a sudden and violent reassessment of the entire sector's long-term viability.
But here's the most critical takeaway from the day. This event didn't sink every company with AI in its pitch deck. In fact, it did the opposite. It acted as a violent catalyst for what we're now calling the Great AI Sorting. It forced the market, in a single session, to stop buying the AI hype and start demanding AI profits.
And right in the middle of all that software carnage, you get this quote from Palantir's CEO Alex Karp. As his company's stock was soaring after spectacular earnings, he framed their success perfectly. This wasn't just a lucky day. It was validation for companies that are actually deploying AI in the real world and generating tangible and, more importantly, profitable results from it.
And this comparison just illustrates the divide perfectly. On one side, you have Palantir, which just posted a staggering 70% year-over-year increase in its U.S. commercial revenue. That is a hard number that proves its AI platforms are not just a science project, they're in high demand. And on the other side, you have the broader software sector, proxied by the IGV ETF, facing an existential crisis. The market's message is loud and clear. The era of funding stories is over, it's now demanding results.
So where did all that money fleeing the IT sector go? This S&P sector map shows the destination clearly. Capital flooded into defensive and real economy sectors. Energy was the day's biggest winner, up over 3%, getting a dual tailwind from the rotation and rising geopolitical tensions in the Middle East. And you also saw significant strength in consumer staples and industrials, sectors that are grounded in the physical world, not just code.
And this massive capital shift has a name. It's the Great Rotation. It is a classic defensive playbook.
Investors are selling high-growth, high-valuation assets whose future earnings are suddenly in doubt, and they are rotating that capital into stable, profitable companies in the real economy, businesses that produce tangible goods and essential services.
And maybe the most powerful symbol of this great rotation was Walmart. While the tech titans were bleeding billions in market value, this retail behemoth gained nearly 3% and crossed a $1 trillion market cap for the very first time. You couldn't ask for a clearer signal of where investors are placing their bets: on proven profitability, pricing power, and stability.
Now, a rotation of this magnitude doesn't just happen in a vacuum. There were a series of underlying macroeconomic factors at play that created the perfect environment for this kind of massive capital shift.
First, let's look at the bond market, because this is where things get really interesting. The 10-year Treasury yield actually fell by 1.4 basis points. Now, under normal conditions, lower yields are a massive tailwind for tech and growth stocks. It lowers the discount rate you apply to future cash flows, making those distant earnings more valuable today. But today, the micro, company-specific fear of the SaaS apocalypse was so powerful that it completely steamrolled that positive macro signal for the tech sector. That decoupling is extremely significant.
So why did yields fall in the first place? Well, the driver was a subtle but important shift in political calculus. The market started reevaluating potential Fed chair nominee Kevin Warsh. The initial perception was that he was hawkish, meaning he'd favor higher rates. But the sentiment has now shifted, with traders betting he might actually be more dovish, potentially leading to earlier rate cuts. It's a prime example of how Fed watching directly influences the entire fixed income market.
Next, you have the CBOE Volatility Index, the VIX. It surged over 10% to close at 18. This is the market's fear gauge, and a jump of this magnitude is a direct measure of rising investor anxiety. A VIX at 18 tells you that the options market is pricing in a significant increase in expected volatility over the next 30 days, reflecting the deep uncertainty created by the tech sell-off.
And this is the final, crucial piece of the macro puzzle. The rotation into cyclicals was given a huge boost of confidence by a very strong ISM manufacturing index. This is a key indicator for the health of the U.S. industrial economy, and it hit its highest level since 2022. This report provided hard evidence that the U.S. economy, outside of the tech sector, is actually quite robust, which gave investors the green light to pour capital into sectors that benefit from real economic strength.
So, what does this all mean for portfolio strategy moving forward? The day's events really laid out two very distinct paths for navigating this new and far more discerning market environment. And the two paths are quite clear. On one hand, you have an aggressive strategy that leans into this new AI reality by focusing on its physical needs. On the other hand, a classic defensive strategy that prioritizes stability and aims to shield a portfolio from the volatility that is now clearly gripping the software sector.
Okay, the aggressive strategy pivots away from the uncertain world of AI software and focuses on the tangible, physical layer of AI. This means investing in the picks and shovels, the power grids, the data centers, the industrial components required to run these massive models. This theme also includes defense, given the rising geopolitical temperature. The primary risk here is that a conflict between the AI giants themselves, think NVIDIA versus OpenAI, could disrupt or delay this infrastructure buildout. For exposure, you'd look at something like ITA for aerospace and defense and XLI for industrials.
The defensive strategy is a classic flight to safety and quality. The rationale is to shift capital into companies with predictable earnings, strong balance sheets, and reliable dividends. Exactly what we saw with the strength in Walmart and PepsiCo. The main risk to this strategy is a reacceleration of inflation. If that happens, the Fed could be forced to delay rate cuts, which would make the yield from these dividend stocks less attractive on a relative basis. Here, you're looking at core holdings, like XLP for consumer staples, or MGV for mega-cap value.
And all of this brings us to the final, crucial question that today's action forces every single investor to confront. The AI reckoning has begun. The market has started a ruthless and likely prolonged sorting process between AI-driven hype and AI-driven profits. It's no longer enough to just have a compelling story. The market is now demanding tangible, real-world value. So it's time to ask, which side of that divide is your portfolio on?